1 minute to the closing bell, and helping us get there are our guests Jeremy Bryan, Gradient Investment Senior Portfolio Manager, and David Bailin, Citi's Private Bank Chief Investment Officer. It's good to have both of you here. Let's see where the markets are setting up with that closing bell set to strike in roughly 45 seconds. Now look at that. We have accelerated, as Jared was saying, to the downside. The Dow off 200, almost 50 points. S&P 500 is down more than 0.5%, and the NASDAQ has fallen. It was positive just 45 minutes ago, but it is now down 90 points. When we take a look at who is leading us down on the Dow, some of the losers today, Visa, they're off by about 2%. Verizon Communications down almost 2%. And JP Morgan Chase is off by about 1.5%. We're going to keep an eye on all of that. But right now, I got to let you know, we have a closing bell. Let's hear the music. Kaboom, we have a closing bell, and let's see where the day will settle. We were talking about how far we had fallen, and then again, when you take a look at this, the Dow off 250 points, S&P 500 settling down 30 points, and the NASDAQ off roughly 93 points. Let's go to our guest, and let's kick it off with Jeremy. The U.S. consumer, you point out, is still somewhat pent up, even if all those ships off the California coast have stuff we can't buy because it hasn't been unloaded. So what good is having pent up demand if I can't get the stuff I want to buy?
The good news is that, that supply issue tends to be temporary, right? Is that eventually that's going to get off the boat, right? We're going to have supply issues for a little bit longer here, but I think that'll just work its way through. The nice part about the U.S. economy and markets in general is they usually follow what the U.S. consumer does, and the U.S. consumer wants to spend. And so that's why we're still positive on the markets. These supply issues are going to have to work their way through. I don't know if that's days, weeks, or months, but eventually that will work its way through, and I think that pent-up demand is only going to cause better spending down the road, which will help markets even further.
David, you have some optimistic outlook as well when it comes to the markets. And in particular, you've pointed out that the things we're all paying attention to right now will pass. For instance, the energy problems in Europe, unintended consequences. But again, you see that abating. So what does that mean for us as investors here? What are we, for lack of a better term, freaked out about today that will actually ease up in the next couple of months?
Well, we're definitely freaked out about, crude oil prices. We're definitely freaked out about slightly higher interest rates. But we have to put all of this in context. First of all, interest rates have been abnormally low. Energy prices are high due to excessive demand right now and delivery shortages across Europe and now in China. And again, these things will abate. We think that it'll take somewhere between 3 and 9 months for energy supplies and for the shipping issues to abate. During that time, consumer demand is going to stay high because it's unsatisfied. And because it's unsatisfied, it means that prices are able to pass through, and retailers are able to make their margins, and people, for example, in the home improvement area are going to make their margins. And as a result of that, profit margins, which were very high for the last 2 quarters, are going to remain high. And I think, therefore, in the cyclicals, we're going to see very good earnings reports coming up. But we are going to see the economy slowing, which I think is, in fact, sort of a given as we go into 2022. So earnings up, the economy is slowing, rates are going to stay modest. And I think that sets us up for, a 7 to 10% increase in stock values over the course of the next 15 months or so.
That sounds optimistic, Jeremy. Following up on that, though, we're going to get the banks Wednesday. We start getting the bank reportings. What are you going to look for? What do you want to hear from the big banks?
That they're loaning money. Really, I want to hear that because I want to make sure that the expense lines are taken care of. And that's just generally, at the end of the day, this is, the tailwind of rising interest rates. And we think we've seen the lows of interest rates in the year. So if we think interest rates are going to rise, that's going to be a natural profit engine for them. So as long as loans are coming through and they're able to get that, and it shows economic activity, along with them controlling expenses, they're still relatively cheap. Maybe not to themselves historically, but certainly to the market. So I think there's a long runway of growth still there. The valuations aren't stretched. They can go up even higher. So I think there's an opportunity there. As long as that's coming through and they're showing economic activity, there is definite upside in those financial names. And the regionals and money centers are both going to feel it.
Let me follow up real quick about the banks, because with rising interest rates, it's a scenario, though, where less is more, right? If they're originating fewer loans, but at higher interest rates, with the loan loss, they were cutting back on loan loss reserves, so things were looking good well before all of this. Is that the storm, the perfect storm that's setting up for them?
Yeah, I mean, at the end of the day, if they can get economic activity because people want to do things, and then secondarily get it at better spreads, I mean, that's natural profit for them. I mean, that is what a bank will do well in. That is their perfect scenario. So in that regard, if we feel that's our base case scenario, we want to be investing in the financials as a result.
When we talk about the financials, though, David, is there something that could upset the apple cart that we would hear from the big banks? Is there something that you would pay attention to that would, slow this down?
Not for the U.S. banks, not at this time, and frankly, not for the European banks, which are valued even less. I do think that the issue really will be their ability to generate loans. And right now, the data suggests that it's really hard for them to do that, that as a percentage of assets or a percentage of, deposits, loan issuance is relatively flat at this point. And that speaks to the, absence of demand and, of course, increasing balances on the bank balance sheets. So I think that we are going to also see, a slightly steepening yield curve for the banks, which is good for them as well, but not necessarily anything incredibly dramatic. So slight tailwinds, and it really depends upon those that are best at actually getting loans out.
David, the PR people don't seem to understand we're in the show right now. Let me follow up with what you just said, though. With the banks, when we start getting the loan origination numbers, wouldn't a rising interest rate environment hold some people back, or would we see a rush of people to get in before interest rates really start to go up? Because I don't hear anyone talking about the 10-year, for instance, being above 2 anytime fast.
Right. So we're in a period now, I think, of financial repression, where rates are likely to stay low for a very long time. We're talking about, a period when deficits have gone way up. But let's just take a look at what's going around the world. First of all, you have negative interest rates in Europe. You have slow growth in China and arguably the need for rates to go down there in order to support their market, especially what's going on in terms of the real estate and technology areas. And in the United States, you have a slowing economy coming off of a very, very fast comeback from the pandemic. So there shouldn't be especially high pressure to have yields go above 2%. And I just want to bring everyone back to the idea that when we started in December of 19, prior to the pandemic, rates were around 190. So to come out of the pandemic, as well as we will, and I mean the Western societies will, and to actually have rates no higher than they were at that time, I think is considered a success and something certainly that the economy can tolerate.
So let's as we wrap this up, let me start with you and go back to Jeremy. When we get into earnings season, we're going to have Delta on Wednesday. We're going to have the banks on Wednesday. As investors, it all boils down to where am I going to make my future profit? Is it time perhaps to pull back, even with the guidance we'll get? We're going to be better year over year, that's a given. But is it time to maybe sit out a couple months, or is it time to actually be getting in? Jeremy first.
Oh, I wouldn't be sitting out. And the reason for that is actually the market's getting cheaper right now. If you think about it, just what we've done lately here is we're expected to grow earnings at almost 25% over the next 2 years. We're not growing that fast even from a market perspective. So the market's actually getting cheaper. And there's certain areas, and you just highlighted them right now, that actually haven't participated that well lately, have been on the downslide, is that the fintech names like Visa, MasterCard, PayPal, Global Payments, these types of names have actually seen a little bit of reversion. And they're all based upon transactions. So in that regard, I mean, there's a lot of space to still make a lot of money. There's a lot of stocks that haven't, frankly, worked as well as some of the others that we think are opportunistic to be getting in now. And yeah, we'd be taking advantage of any correctional opportunities to get more aggressive as we go.
And David, for you, I mean, you talk about an equilibrium.
Yeah. So look, market timing is a terrible thing. And, any client that actually tries it actually gets hammered over a period of time. You have to divide the market into halves, right? The cyclicals right now, earnings are catching up with their valuations very, very easily. They are not expensive. In terms of the growth stocks, you have to be highly discerning. You've got to look for those that can sustain above average growth, 15 to 20% growth for the next 2 or 3 years. The earnings for those stocks, the cash flows for those stocks have to catch up. They've done extraordinarily well in the pandemic period of time. And I think there will be a reckoning for some of them in 2022 and 2023 if they can't keep up. But in terms of being in the market, if I had a choice, you want to buy quality companies as you go into this market period, those that are market leaders. You want to buy companies that have good, strong dividends and the ability to increase them. You want to buy areas like healthcare that do well in the mid-cycle. And you want to expose yourself to a handful of emerging markets which really have grossly underperformed. And if you do that and you diversify your portfolio over the course of that 18 months, I think you can do very nicely, and it will definitely be better to be in the market than out.